As bond yields rise dramatically in the United States and around the world, the American stock market is still trying to move upward with 7 stocks. Will this effort translate into a broader rally, or will it be in vain? Despite positive expectations for October, will American stock markets come down sharply? In this video, we will evaluate this. Let's get started. Review of the agenda and markets. Yes, as you know, since the establishment of this channel, I have been discussing American stock markets in weekly videos. Why especially American markets? Because it's the world's largest stock exchange, and the world's largest companies are traded here. The fate here, developments in the bond market here, affect the whole world. Therefore, crises starting from here, especially the 2008 crisis, were closely monitored. The positive sentiment that started from here has always spread to the world, just as it benefited from years of excessive money printing. Similarly, we also suffer from the negative effects. Therefore, not seeing these facts, ignoring them. These temporary perceptions, unfortunately, cannot be escaped in the long run. You can organize short-term movements. On Friday, an interesting data came out, A very high employment figure came out. When you look carefully at the data, you actually see an incredible increase in part-time workers and an incredible decrease in full-time workers. This trend has actually been going on for the past 3 months, and in the past 3 months, there has been an incredible increase in part-time jobs but an incredibly sharp decrease in full-time jobs. So, if you look carefully at the structure, you will see that unemployment, the number of people working multiple jobs, is increasing. In an environment of high inflation, one person works in 2 to 3 jobs to make a living part-time, and the same people seem to have increased the number of jobs as if there was a lot of work. But there is also an incredible decrease in full-time jobs, a decrease of around 700,000 in 3 months. Therefore, when examined carefully, the data is not improving, but when presented in this format, it seems to be improving. All year long, the revisions backward were always negative, but this time, backward revisions have been made positive. This is a very critical data point, and it has been debated whether the jobs are very important this time, and because of that, in the next data release, they will continue to make negative revisions. You will see, it will be like that. Therefore, America's debts are continuing to grow wildly. Therefore, let us remind once again that the possibility of paying off that debt is gradually disappearing. This process will end with wars, as I was saying, and unfortunately, wars are continuing in different parts of the world. On the other hand, U.S. Treasury Secretary Janet Yellen still believes in a soft landing, but she also said that there is no need for higher interest rate hikes, as you know. But looking at this picture, I think she may be living in a virtual world, probably wearing virtual goggles and wandering around in that world, confusing it with real life. So, she may be making such a mistake. The fact that the interest rates in America have been zero for so long. Throughout history, even before the Common Era, including 3,000 years ago, there have been periods when the interest rates of reserve currencies were zero, especially during times of crisis, like the Great Depression in 1929. And this has happened in recent times as well. So, this has become a habit, this zero-interest environment in America, and it became a habit with the 2008 crisis and the recent COVID crisis. But a sharp rise from here will have consequences beyond normal. Waiting for this to end normally, and in just the past 2 months, in 2.5 months since July, there has been a loss of nearly $4 trillion in the positions in the bond market, in global bonds. The numbers are quite outrageous, so it's not normal to expect this to end normally and be paid off. After all, America will print and pay. That logic, because no one is buying American bonds, is pushing interest rates higher. That will create a need for wars in some parts of the world, and in the end, there will be a big reset, unfortunately. This game will not end normally. It will not end without significant problems, especially without a major collapse in risk instruments. While I'm saying this, Barclays published a report saying the same thing. I saw for the first time that a foreign investment bank published a report that was close to my views, so I will question myself. Because Barclays says that the clearest way to prevent this collapse in the bond market is for the stock market to collapse. Only if money comes out from there can it move to bonds, and the system can save itself. Otherwise, as interest rates rise and they still try to push the stock market up, it will not be possible to ensure cash inflows here. Therefore, a recession perception will only bring interest to bonds. So, long-term bonds will see an increase only if this happens, and as long as that doesn't happen, unfortunately, this problem will continue. In that sense, the Barclays report is very important. I have been trying to explain for a long time that the bond market needs to collapse the stock market to save itself, and that it will not end normally. Especially, without a big collapse in risk instruments. While I'm saying this, let's analyze the movement on Friday. Nasdaq closed above my tracking level of 14,950, but it was a somewhat fictitious rally on Friday. As you know, Friday movements are tricky. From a weekly perspective, it seems like a double bottom is forming here. In the short term, it has reached the 618 Fibonacci level, which is exactly 15120. Technically, if it cannot push above this 618 level, which is 15,120, the movement is already suitable for completion from this region. But if it continues, we will really look at movements towards the peak, or at the end, there might be a collapse from there. So, we will pay close attention to this movement because no matter what you do, you can manipulate the market as much as you want, but the problem will remain until you see this reality. Because there's a big elephant in the room, and even if you don't want to see it, it's not easy to get that elephant out because it doesn't fit through the door. So, until you see this reality, unfortunately, you can manipulate the market as much as you want, but in the end, what will happen will happen. It's just a matter of timing, and that's what we're trying to predict so that you don't get hurt in this process. In fact, you can make money with reverse trading, so two-way trading is essential if you are trading in these markets. Returning to charts, on the weekly chart of Nasdaq, if it closes above 15,164, my tracking level, you can see that it may go there. But if the week closes there, it will gain a short-term lower signal officially. So, we will closely monitor this week. Friday's movement was indeed strong, we have to admit that. But how far the manipulative algorithmic movement, which is far from reality and is carried out with manipulated data, can go, they can take it a bit further, and then, according to some theories, sales may come with OPEX on the 18th of the month. We will look and see. 1 or 2 more weeks may be possible. We will see if they can take it further. I am skeptical about it going that far, especially since I see the possibility of more war news coming to the world. So, we will closely monitor them. In the S&P 500, there was a recovery on Friday at the 4334 tracking level, but it was a bit less. You know, because it's done with only 7 stocks, operations always struggle to match the full 500 stocks in the S&P. Since 93 out of 100 stocks in Nasdaq are involved, the proportions there can cause more significant movements. So, they can better organize manipulation there by manipulating options with certain stocks. We will see if this continues. As long as it stays below the 4344 tracking level, there is potential for an upward movement, and we will understand from there if a new rally is coming. Dow Jones was even weaker. It closed below the 33820 tracking level and is trying to recover. Look, the closing of the year was at 33147, and we even dipped below that, and then there was a bounce. Dow Jones dropped much more than the others, especially due to the recent drop in oil prices. So, there might be some rebounds from here, especially on the Dow Jones side. It has more potential. If there's going to be a rebound, I prefer staying on that side, and there might be a recovery in energy stocks at least, or I will talk about healthcare stocks in a moment. Apple, the world's largest company, closed right at my tracking level of $177.30. It can be positive above that, but whether this rebound will be limited or not, we will understand from the daily closing above the nose. So, let's closely monitor this area. Tesla was a bit more positive, but after the closing, they made price reductions again. Normally, they keep reducing prices rapidly, which will significantly damage profitability, but they are trying to maintain market share. Thus, Tesla, which was sold for $120,000 at the beginning of the year, has dropped to around $80,000 to $75,000 now, and it's being lowered even more. We'll see how far this will go, but in the end, it affects profitability, but they are trying to hold on to a broader market share. There are many positive developments in the electric car industry, but also many problems. Over time, they will also be understood. Anyway, I don't want to go into too much detail now. Tesla closed above $254, which is my tracking level. As long as it stays above, I interpret it as positive. If it closes below, I see it as negative. Nvidia, the largest company in the bubble, as you know, has gone above my tracking level of $441, currently at $450. However, here, a typical head and shoulders pattern seems to be forming. The shoulder has formed, and the head has formed. So, if it turns from anywhere around here and closes below $441, I expect at least a drop to around $300, and I even expect more, but for now, I'm waiting for that gap to be filled, and then the possibility of this movement in Nvidia. However, be cautious as long as it stays above the tracking level. Protect yourself and don't damage your portfolio with reverse trading. Amgen, as you know, I mention it from time to time, is one of the world's largest biotech companies and one of the top 10 healthcare companies in the world in terms of revenue. As long as it stays above $264, Amgen's direction is upward. There have been interesting developments in the healthcare sector this week. For example, there was an announcement from Walmart regarding Ozempic, a drug by Novo Nordisk, a world-famous Danish pharmaceutical company. It was developed as a diabetes medication, but because it overcomes weight problems and insulin resistance with a $1,000 monthly injection, it has become very popular. Everyone in America is using it, and Walmart made an announcement about it. It has become so popular that there have been statements about a decrease in sugar and junk food sales. We can see that the shares of many companies in the junk food market, such as McDonald's, have dropped significantly. Therefore, there is a frenzy called Ozempic going on right now. Novo Nordisk has rallied significantly but has dipped slightly below my tracking level of $93.50. If it continues to dip, the movement may continue. However, Ozempic, the rival company, is more prominent. Eli Lilly, currently the world's largest pharmaceutical company in terms of market value, has also gone above my tracking level of $540. Eli Lilly produces rival drugs in competition with Novo Nordisk, primarily focusing on insulin resistance and weight loss. Obesity is a significant problem in the United States, and there have been statements about a decrease in sugar and junk food sales due to the popularity of Ozempic. Eli Lilly is a large company, and it's interesting to note that it has surpassed the market value of Pfizer. Pfizer has better potential as a pharmaceutical company, and I recommend keeping an eye on it, especially as it is considered a defensive sector. Now let's take a quick look at cryptocurrencies and how these developments might affect them, especially with a focus on war-related news. As of the time of this recording, Bitcoin is trading at $27,900, and it's a critical level. If it stays above $27,280, there may be further upward movement. However, there's a possibility of a head and shoulders pattern forming, and we need to closely monitor it. Ethereum is below my horizontal tracking level of $1,680, but I continue to look at it positively. These are uncertain times with global tensions and conflicts, and I've shared my concerns about how these events may impact financial markets. The bond market and rising interest rates are not issues that can be easily brushed aside and resolved overnight. There's a risk of entering into a recession or stagflation if certain measures are not taken. I hope you found this broadcast informative, and I'll continue to provide insights and guidance in these challenging times. Wishing you all cautious and profitable days ahead.